Podcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our once every 3 weeks members or Investors Observer members only workshop. Welcome, and let's get started. All right, so here's our agenda for today. We have a note about new things at Investors Observer, and then we'll do a market update. And then the rest of the session is questions. So we got a bunch of great questions ahead of time. Thank you to everybody who sent in questions. If at any point from now forward you have questions, you can type them in the question box, and I'll either get to them as I'm talking if it's relevant to what I'm talking about in that moment, or I will come back and hit as many of them as I can at the end. All right, so we don't have a lot to announce this week, but we do have one thing that's exciting, at least to me, in terms of new at Investors Observer, and I think some other people will probably enjoy this. Let's see here. We have made it so if you're on one of the screeners, either the stock screener or the option screener, you can open the stock page from here in a new tab by clicking Control or Command on a Mac. And now you have both of these tabs open. The same thing works on the option screener. Just find something you like, Control click, boom, opens in a new tab, and I have the screener open so you can go back and forth like that. All right. That wasn't the biggest product update, but I know that's the thing that I've been looking for a long time, and I feel like we've gotten some other requests for it as well. So that's there now. You just have to hit Control or Command, and it opens right up. All right, so on to the market update. This is our standard charts, 1 year daily candles. I forget exactly where our last workshop was, but since then we did have that little episode where we bounced off the 50-day moving average, and now we're back, and kind of got a little bit extended, but kind of pulling back in again now. So that's kind of where we are. As far as that goes, there's not a whole lot exciting to talk about. You bounce off the moving average, the 50-day, not infrequently. It's not super surprising. This long stretch without doing it is probably more surprising. So yeah, that's that. And then, all right, so this is the S&P 500 in white versus the equal weight in blue. So what this will show you is the relative performance of essentially the big names at the top, right? Your Apples, Microsoft, Google, Facebook, those 5 companies that make up just a massive part of the S&P 500. We talked a lot last year in 2020 about those big companies really leading the way, but we've started to see the smaller companies come on more recently. It's interesting that the gap here sort of narrowed during that period where we bounced off the, where we pulled back and then bounced off the 50-day moving average. What that shows you is that people hold on to the bigger names, right? Like people might sell a smaller stock when they start to get worried about the market going down, but they hang on to their Apple a little bit more is what that is. And then, so this is the S&P 500, again in white, versus the Russell 2000, which is all small caps, like things that don't qualify for the S&P 500. And obviously the Russell has really taken off since early November, and pulled back more than the S&P did. You can see that down leg is less than that down leg when we had that little disruption a few weeks ago, but back up now. But you see here, even as if we go back to the S&P 500 chart, this isn't really a pullback. It's more of a rest, but the small caps have pulled back a little bit here, and that sort of thing is normal. Those small caps tend to be more volatile than the large caps, and especially if you do it at the index level, it tends to be a lot more volatile. All right, and then we have the XLK, which is the technology ETF, versus XLI, which is industrials in blue. We talked last time about some relative outperformance from the industrials, and that has sort of gone away since we had this this pullback, it seems to have switched a little bit. Again, some of that is just the tech stuff people hung on to, but also, as we'll talk about in a few minutes, coronavirus and economic recovery is a much bigger deal for industrials than technology, right? I mean, industrials are things like airlines and places that make things, whereas technology is obviously things like computers and iPhones, but also a lot of services that are available online. And so those things, just tend to hold up better when people are worried about the economy, especially if they're worried about something particular with the economy, like say a coronavirus that keeps people at home. All right, but what has started to happen is financials have started to spread out a little bit and pick up some pace against, again, the XLK is still the white here. The blue this time is the financials. So I'm not going to get into bond yields with everybody, but there have been some, bond yields have been rising a little bit. They're still historically low. They're still well below levels that would have been considered historically low a couple of years ago even. But they have started to tick up, and that combined with some genuine green shoots and good things going on in the economy are reasons that financials will start to rise. All right, so what else is happening? We still have a very sort of virus-driven, virus-dependent economy. Things are looking good in that regard. Cases are falling, all the other things, hospitalizations, death rates, all those things are falling. A lot of this is just moving past the post-holiday surge. A lot of people traveled for the holidays. A lot of people spread coronavirus around while they were doing that. And so that, that's how that happens. But now that cases are falling, there's some risk that people may let their guard down. We'll see how that goes. I don't expect it to be as, Thanksgiving and Christmas right there together. You sort of had that sort of a perfect setup where cases were rising moving into Thanksgiving. A bunch of people traveled for Thanksgiving, and then you pretty much nailed the gap between Thanksgiving and Christmas in terms of exactly how long you needed to have one thing really multiply the second thing in terms of infection rates, and that's pretty much what happened there. And yeah, vaccine production is ramping up. More of that's going to get pushed out the door very soon. That also obviously helps in terms of spreading, letting people feel feel better about going out and doing things. And then, from an economic perspective, warmer weather being on the way really helps things like outdoor dining. I think a lot of restaurants are probably shut in and only doing delivery right now. They can start doing some, more of them can start doing more outdoor dining soon. I know, I've seen pictures of people in New York all bundled up trying to eat outside. That's not for me. But if you can eat outside without having to wear, try to use a fork and wear mittens at the same time, I might be into that. And then, it seems likely more economic stimulus is coming. Republicans still seem likely to try to block most of his agenda, but I think some stimulus checks, some unemployment relief, things like that. Where it starts to get tough is the things like raising the minimum wage and some of the things that are would probably be good for people, but maybe less directly related to coronavirus. Those get to be a harder sell, and it's difficult to know exactly which ones of those will get through. But I do think some checks and some unemployment benefit extension will come out. All right, and then some of the fast data. We look at this stuff for a year. When we started doing this, the situation with the coronavirus and the economy was moving so fast that we couldn't really look at things like unemployment and some of those things. Yeah, so Chase has actually added a second line to this. So the blue line or purple line, whatever color that is still sort of year over year change, but somewhere around the first or second week of March, we're going to start running into, right, we're going to catch up with this guy. is essentially what's going to happen. Right, once we get to, it looks like it really starts to drop off a little after March 20th. Once we get into there, then your year-over-year comparisons start to get real weird. So they've added this other line that is relative to the pre-COVID trend. Okay, so you can see that, essentially we're still, what does this say? Between, it's been sort of fluctuating at between 3 and 4% down from the year ago. But then the trend, we're somewhere closer to 10% down, because the trend would have kept going higher. Economies tend to accelerate over time and not stay flat. So where we are in terms of the trend. So what we want to see actually is not just for this gap between here and 0 to close up, but actually for between these two lines to close up, because that will be closing what's called an output gap in economic terms. And that's essentially, even as we've recovered, right? We've, not at the bottom anymore, but we're not back to where we should be. Like, we're still a little below where we were, but we're a lot below where we should be. And so that's what these two lines are measuring. All right, and this is the flyer data from the TSA. You can see the Thanksgiving and Christmas, sort of travel spikes, and then things went down, and now it's starting to go back up again. We'll see if we start to get, coronavirus infections going back up again along with that traveling. I don't really know what to expect from that exactly, but it will be interesting in any case. What we'd like to see is sort of, as the economy reopens anyway, setting new highs and moving back up, just like we would like to see, with a stock chart. All right, so that is, that's all the sort of market update, etc. Except we did get a bunch of questions that are related. So we're, into the questions now. This one came from Deborah, and she said, historically, when the S&P 500 PE ratio goes above 20 to 22, it doesn't bode well for overall returns in the decade that follows. In December, the S&P 500 PE was 44.2, and the total S&P return adjusted for inflation the following decade was minus 39%. As of today, the S&P PE is 35.6. First of all, that December 1999 to December 2009 period manages to be the sort of 10 years that captures both the dot-com crash and the 2008 crash. There are really very few other 10-year periods in history when you have two major corrections like that. And those were really beyond correction, right? Those were full-on crashes. There aren't really very many 10-year periods in history when you have something like that. And the thing about PE ratio is it's a ratio. So yes, I tend to agree sort of with the premise here that a high PE tends to come back down, but there's a couple things going on here. First of all, the idea that there's a level that is too high and it has to come back is probably true, but the definition of too high, I think, sort of remains in question. We'll talk about that in a second. The other thing is PE is a ratio. Okay, so it's price divided by earnings. And so that ratio, right, goes up as price goes up, right? If, fractions, 3/4 is more than 2/4, and 4/4 is more than 3/4, etc. Right? So that goes up as, as the top number goes up, the total value goes up. But you can also change the bottom number, right? As the E rises, the total value goes down, right? Because 3/4 is, 3/4 is 0.75. But if the E goes up, right, if you make it 3/8, now you've got way less, okay? Or even 3/5 is less than 3/4. So if earnings go up, that will lower the PE ratio and you don't actually need a crash. And so all the things we just talked about on the last slide in terms of, vaccines, more stimulus coming, warmer weather coming, all those things should help raise the E which will, if prices stay the same, pull that PE ratio back down. The other thing that I think is interesting here is if you look somewhere around a little after 1980, right? Like everything sort of pre-1980 is in a very pretty much tight range, right? Like we get above 25 back before 1900. And there's a couple other spikes, but it's pretty steady. It's not a huge range. And then around 1980, things start to go up and they never come back down as low as they did before. Okay, so if we were to draw a line here and have two data sets, the pre-1980 average PE is way less than the post-1980 average PE. Okay, when I started following the stock market, 15 PE was considered to be fair value. Go look at the stocks that have a 15 PE these days. They're, I'm not saying they're bad buys, but they're pretty boring and not necessarily growing pretty fast. You can have a PE that's much higher than that for a lot longer, and it's fine. And so, yeah, obviously this seems like it's, in the upper extremes, but I'm expecting earnings to grow and maybe grow big over the next year. We'll see how that goes, and then yeah, it's possible things could move up and down a little bit, but I don't necessarily think there's a big crash coming. I certainly don't think there's a 1999 or 2008 coming. I mean, one of the interesting things about this is it really blew off because bank earnings were a huge part of banks were a huge part of the S&P 500 before the 2008 crash, and their earnings just went to zero or even negative before the market really rolled over. And that's to get back to my earlier point about E going up can pull the PE down. If E goes down, it pushes the PE way up. So that's part of why this got so crazy high here, is actually that earnings just plummeted before stocks started to fall. So if you normalize those things, they can normalize from both directions, and you end up not having a particularly severe correction, and things work out. All right, so then we got another question about a crash from Michael. He said, as a result of the unprecedented influx of money from central banks and governments to prop up the economies worldwide, and in particular America, what is my opinion on the risk of a major correction this year? All right, so let's talk about the major influx of money from central banks. Central bank policy works mostly by trying to encourage lending. Okay, so commercial banks in our monetary system control the money supply. So the money supply grows when the economy grows. That seems a little weird. I get it. It's not really how people normally think about it, and most people don't really think of commercial banks as controlling the money supply. But if you think about a bank, a loan that a bank makes is an asset on the bank's books. Okay, deposits are essentially, think about it, you give money to the bank and then you can go get that money back plus some interest. That's a loan that you made to the bank. So to the bank, a deposit is a liability. A bank with more deposits and loans would actually have more liabilities than assets. Most businesses try not to have more liabilities than assets, and banks are no different. Now, banks can't just get $1 in deposits and immediately lend out $2. Banks actually start with some shareholder money or some other source of capital, which is the first lending dollar, if you will. So that's how that starts. But so banks lend money in excess of their deposits, and that helps raise the money supply. When the economy starts to shrink, people start to get worried about things. Banks start to get tight with lending. That starts to shrink the money supply. As banks stop making loans are getting paid off, the amount of sort of money in the system contracts. So the Fed does things like, the first move is always to lower interest rates. That means that banks have access to capital and reserves cheaper than they normally do. The idea is they'll try to push more money out into the economy and grow. There's a thing called the zero lower bound. Interest rates can't go below zero. So what happens is the Federal Reserve starts to buy treasuries. So when it's doing this, it's taking a treasury bond out of the world and replacing it with reserves in the banking system. So now banks have extra capital. They don't have to hold their capital on reserve at the Fed in case of an emergency. They have capital because they sold a treasury bond to the Federal Reserve. And it creates new lending capacity that way. The other thing that buying bonds does is it lowers the returns on bonds. So it takes some bonds out of circulation, and also it means that the bonds that are still in circulation are less attractive because the return is lower. And so what that does is it encourages other kinds of investment. Banks aren't the only buyers of bonds. There's pension funds, regular investors, people like that. So if you want to get some return on your money, treasuries start to look less attractive. You go sort of, look elsewhere in markets to try to find some attractive return. Okay, so this money creation works to prop up markets. It is kind of inefficient, though, in terms of spurring demand. Okay, so if you think about what do you need if you're running a business, you're not going to go be like, oh, loans are super cheap right now, I should get a loan, unless you have something you can do with the money. You borrow money to fund some growth or some other thing, right? Like that's why you would borrow money. So having cheap money available is great, but you need to have some demand. There's some reason for you to want to borrow money. So that's the other side of the puzzle here, is the demand side, which we'll talk about on the next slide. And so yes, the yield return pushes up the price sets of other assets, right? So not only are loans super cheap right now, but equity capital is also super cheap. Tesla can raise $1 billion for way fewer shares than it could have pre-crisis. And what that means is every Tesla shareholder gets diluted less for that $1 billion than they did before. Okay, so equity and debt capital are super cheap right now. And yeah, the cheap money doesn't create demand. You need to spur some demand for businesses to want to borrow. All right, so the other side of the coin is fiscal policy. That's government spending. Okay, so governments can, literally just cut you a check. That can create demand to some degree, right? You certainly have more money available to spend. You might go buy stuff you wouldn't have bought before, do some other things you wouldn't have done before, in terms of spending money. Now, the pandemic seems to have lessened some of those effects. I talked earlier about, restaurants, things like that. That's a lot of places where people would normally spend money are unavailable or unattractive right now. So I do think there's some, pent up demand, and that has probably pushed even more assets into chasing yield. Okay, I don't think it's a coincidence that, we've seen this huge influx of new investors into the market. All kinds of stuff has happened in terms of new people starting investing, which is great. That is historically a great way to build wealth. And it's excellent. I'm glad to see all those people, be able to do that. But people investing isn't necessarily people spending money in the real economy, which is kind of the goal of this fiscal policy here. Okay, so now that we've set the table for all of this, when's the crash? Right, so I'm not sure that's coming. Okay, so the downsides of all this are potentially inflation, right? You increase the money supply, potentially you have too much money chasing too few things. Okay, okay, let's get to these bullets in order. First of all, the Fed's balance sheet can be used to fight inflation, right? So if people are worried that the Fed having a big balance sheet is going to cause inflation, they can stop buying bonds or even sell some bonds. So the balance sheet goes back down, right? They can raise interest rates. Okay, all the things that are being done that might cause inflation can be undone pretty quickly from the Fed side, right? Not a problem. Okay, so inflation doesn't just mean more money. What inflation is really is it means too much money chasing too few resources. And so there will be almost certainly over the next year, some price spikes in various things. Okay, I mean, we've already seen, like, I don't know if anybody's looked at the price of lumber lately, either in financial markets or just gone to Lowe's and try to buy some wood. But yeah, I had to just cancel a project because I couldn't find the lumber. So there's some stuff like that. That's going to happen. And there's probably some other stuff, all this weather in Texas is going to create some weird demand for oil. So you may see some other interesting commodities as restaurants reopen. I would expect in the same way that when things closed and all the supply chains had to adjust in terms of like the rolls of toilet paper they sell at the grocery store are different than the rolls of toilet paper that you have in your office. And so when everybody started buying toilet paper at the grocery store and stopped using the office toilet paper, we had some supply shortage, right? Some things like that are going to happen in the next year as things start to go back to normal. That's not really the same as inflation, though. You need to see some sort of sustained economy-wide thing for it to really be inflation. And yeah, to the extent that some of this new spending in new places is permanent, there's plenty of fresh, cheap capital that's readily available for businesses who want to address the supply constraints. And so, the same way we talked earlier about price to earnings ratio is a ratio, inflation is to some degree a ratio, right? It's the relationship between the stuff to buy and the money to buy stuff with. And so if one of the problems is there's too much money and not enough stuff, well, one solution to that is make more stuff. That's happening. And then, yeah, so high asset prices, high again, ratio, right? Growing economy pushes the denominator higher and the price doesn't look so high anymore. So all of that was a very long 2 questions and 3 slides to say, essentially, I don't necessarily think there's a crash coming, okay? The other piece of this, and I'm not the first person to say this, but if I had told you January 1st of 2020, everything that was going to happen in 2020, how many of you think stocks are up by 19% at the end of 2020? Right? So, the thing about economists is, I have a whole other slide about this. Yeah, there it is. And yeah, do you go long speculative things like electric cars at the beginning of 2020? And so the thing that I think all investors should remember is good practice beats good predictions. There's a joke that certainly predates me about the guy that's predicted 9 out of the last 5 recessions. Always being a bear is no better and probably worse than always being bullish. And the thing is, people can't predict the future, particularly with specifics. We know things go up and we know they go down, but we don't know when. So if you're worried about a crash, the things to do are don't risk money you can't afford to lose. Don't be afraid to take profits. If you're sitting on huge gains after 2020 and the run we had up from the bottom, and you're losing sleep about it in particular, take some profits. You don't have to cash out all the way, but you're up a lot. You don't have to let it all stay on the table. Rebalancing is a part of good investing, right? You trim some winners, you buy something that's unperformed, right? You can either, move it to something safer, try to find the next big winners, whatever that sort of process looks like, you move things around. And so then, I want to talk about my bicycle guy over here. Okay, this guy's on the trail because he likes being on the trail. Okay, he put his helmet on, checked his brakes, and picked a trail that fit his skill level. What he didn't do was spend a lot of time at home wondering if today is the day he's going to crash. Because the guy who spends all his time worrying about if he's going to crash, that guy just never gets on the bike. And so, if you're concerned about a crash because you have money you really can't afford to lose, do something safe with it. But sitting in all cash all the time is not a way to make any money. That's not investing. That's just hoarding money, which it doesn't grow if you do that. And the reason to invest is to grow. And so certainly don't be reckless, but at the same time, you take precautions, you do what you can do, and then move on from there. All right, so more questions. All right, so Mark said, please talk about buying options. When I buy one, does it allow you to buy 100? Can you just buy 25, etc.? Okay, so an option contract gives you the right, but not the obligation to buy, or in the case of puts, sell 100 shares of stock between when you purchase it and when the option expires. There are some weird, they're called non-standard options that have a deliverable, which is that 100 shares, that have a deliverable other than 100 shares, but those are usually the result of dividends, a stock split, some M&A activity. They're the result of something, right? Like you can't just show up at the stock market and be like, I would like an option that covers 25 shares or 38 shares or whatever. You can't do that. You buy one option contract, it covers 100 shares. That's the standard unit. And like I said, there's these weirdos out there, but most people don't even trade them. They just, they close and then that's it. So you can trade options. You can buy, you can sell. And yeah, the other thing I hear about this right but not the obligation is options expire out of the money, which means, say, you bought an option or bought a call option that had a strike price of 50. The stock ends up at 45 at expiration. Now you don't want to buy the stock at 50. Guess what? You don't have to. The option just expires worthless and you're only out what you paid for the option. Okay, but the other thing is, if the stock goes to 60, you could exercise the option and buy the stock for 50, or you can just sell the option back to the market. And you never have to actually buy the stock. So the idea of, I want to buy this option that costs $5, but I don't have the money to buy 100 shares of stock, you don't need the money to buy 100 shares of stock because you can just trade the option. You don't ever have to actually own the stock. All right, so you can trade options. You can buy options, you can sell options. You can also buy to close and sell to close. So shorting stocks has been in the news a lot recently. It's not, for a lot of reasons, there aren't a ton of people that short stocks, especially on the retail investor side. There are a lot more people who short options, usually as part of a more complicated strategy. Most people don't just show up at the stock market or show up at the market and sell options. But so you can sell to open, you can buy to open, you can sell to close, you can buy to close. If you buy to open, what you do to close is sell. If you sell to open, what you do to close is buy. All right, and then so you can do those things individually. You can also make spreads. Buy an option and sell another option, and you can do this. There's two basic kinds of spreads. Okay, there's your credit spread, where the option you sell has a higher price than the option you buy, so you actually get a credit when you open the trade. And there's your debit spread, where the option you buy has a higher price than the option you sell, so you're paying in to open that trade. You can buy a call and buy a put, which is a straddle. You can sell a call and sell a put, which is either a short straddle or a short strangle if the strike prices are different. And yeah, from there's more strategies than I can name. Probably more strategies that have names. You can have strategies with more than two legs, or strategies where you buy two options and then sell one, or some other ratio. There's all kinds of things you can do with options after that. But yeah, the basics are all right here, right? You buy to open, sell to open, and then what you do after that. Yeah, all right. So that was a quick options basics. All right, David had a couple of good questions this week, but they're a little bit long. He said he's been studying guidance on long calls, generally going deep in the money to reduce time value. And while that lowers the break even, it also requires more capital at risk and reduces the percent gain. In short duration trades, time value may not change much, but the risk is high with the initial overhead, even if the cost may be lower. If you catch an uptrending stock and are deep in the money, can you sell a higher call to leg into a spread, reducing risk and increasing the return? This isn't, we don't have long calls on Investors Observer. We'll probably add them at some point in the future. But yeah. All right, so in the money is a less risky way to buy calls on a per dollar basis, assuming the expiration date. Okay, that's with some caveats, right? So what you're really doing is moving away from the money line. Okay, so time value goes down roughly symmetrical. Time value or extrinsic value, those two mean the same thing. Go down roughly symmetrically in both directions, okay? So if you go further out of the money, you see the option prices go down. That's right out of the money, it's all extrinsic value, the price goes down. In the money, it gets complicated because you have intrinsic value that you're buying and extrinsic value, but the time value or extrinsic value goes down roughly symmetrical as you move away from the price of the stock. So trades that are roughly the same distance from a 50 delta should have about the same level of extrinsic value. Okay, so a 60 and a 40 should have about the same time value. Right, okay, so if you buy an out of the money call for a nickel, or you buy a call that's $10 in the money for 10.05, you spend a nickel on time value in either case, right? So if the stock stays relatively flat, you lose 100% of the out of the money trade or 0.5% of the in the money trade. Okay, so that's what I mean by they're less risky on a per dollar basis, right? Your percentage loss was way less on the in the money trade than the out of the money trade, but in either case, you actually lost a nickel. Okay, so, and yeah, the theta, as we call it, the time value that goes away over time, that's why we call it time value, should also be roughly the same for in the money and then out of the money. It's just that the percentage is different. So the big difference here is that if the stock goes up by a nickel, your in the money call gains a nickel in intrinsic value, while the out of the money call probably does not. Well, it definitely doesn't gain any intrinsic value. It may see its extrinsic value go up a little bit. So there's that. So in the money calls are essentially a less leveraged way to do options. A 1 delta on Apple for March, when I looked at this yesterday, cost about 87 bucks. So you get roughly $1 for every dollar that Apple stock goes up, but because you paid 87 and not 130 something, your percentage gain is a lot higher. So to get to the actual questions that are contained here, selling a call, right, selling a higher call to move up. So if the stock is moving up and you sell a call against it, the real risk there is the stock runs up past the call you sold and now your return is capped. Because, yeah, either that call caps your return, you have some kind of debit spread, or or you have to buy it back, which either way, anything above the strike price of that, you're just out. So the best way to minimize the time value lost is to buy options longer than you want to hold. Okay, so you don't have to hold options to expiration. You can sell early, like we just talked about. And so in that case, what you're doing is you're selling the time value back to the market, right? So you buy an option for a month, you hold it for a week, you sell 3 weeks of that back to the market. And the theta accelerates on a percentage basis, percent of the extrinsic value, as you get closer to expiration. So week 1 of that month, you lose a lot less time value than you do in week 4. So yeah, on a percentage basis, right? Like it may be a nickel in either case, but a nickel out of 25 cents versus a nickel out of a nickel, it makes a big difference on a percentage basis. All right, so another question about some call spreads. These are vertical call spreads. I actually had to ask a couple of follow-up questions here. So these are deep in the money so that a 10% drop will stay above the sold call and receive the full profit. And usually return is 25 to 50% in less than 2 months. But David's frequently not able to obtain a debit that's that small. The midpoint may suggest a smaller return, but at times you get filled quickly near the net. And in this case, he means net debit, which is just, right, the price of the option you buy minus the price of the option you sell. So what factors determine the net debit and what's the best way to get a good price? Also stock selection. So one of the reasons I had to ask some follow-up questions here is this is kind of incredible to me. Okay, I've looked at 10% in the money credit and debit spreads, or 10% in the money credit spreads and 10% out of the money debit spreads. it's tough to try to get this return. I looked at a bunch of things and I can see where it's there. I can see where it's close. I was kind of surprised. But yeah, I can see where it's close, but you're really, yeah, the problem is exactly what David's describing here. The bid-ask spread can be pretty wide, especially deep in the money. And that's because liquidity is much more about who wants to trade than the open interest. So in the money options tend to have higher open interest than out of the money options. That's because stocks tend to go up. People tend to trade options at the money as the stock goes up. All those options that used to be at the money are now in the money. Now you have a bunch of in the money options with open interest. And there are some other reasons why open interest tends to be higher in the money, but that's the big one. And so people use open interest as a proxy for, can I get in and out of this easily? But that's, yeah, a much better proxy for can I get in and out of this easily is what is the bid-ask spread? A tight bid-ask spread says, hey, a lot of people want to trade this and there aren't a lot of transactions costs. A real wide bid-ask spread says, nobody's really interested in trading this. And so the thing is, midpoints aren't really prices any more than the bid and ask are prices. Okay, they're properties of a range. So you have a range that is the bid, which is the price at which if you put in a sell order, it will fill at the bid. If you put in a buy order, it will fill at the ask. It may fill better, but it will not fill worse, and it will fill at that price. Okay, so the bid is an offer to buy. The ask is an offer to sell. If you come in with the corresponding order at that price, boom, like you just made a trade. That's how markets work. Okay, so the midpoint isn't really a good way to judge these things. Really what you should look at is selling at the bid and buying at the ask, and then you may be able to squeeze it up from there. But as you try to squeeze it up from there, there's really no guarantee of getting any kind of fill at all. And with opportunities like this that are pretty rare just because of how that trade works, you're going to have to move very quickly and find exactly the right thing going on. And executing between the bid and the ask is at the mercy of the market maker. All right, so like I said, I'm kind of surprised at these returns, not surprised by difficulty in getting filled. So this kind of opportunity implies a relatively high implied volatility, but only really at the sold strike, right? Because you want to sell a lot more premium than you're buying, basically. And the best way to get a good price is to use a limit order, which doesn't do anything about making your chances of getting a good price better, but it does prevent you from getting a bad price. This strategy is going to work best with more volatile stocks, but those stocks are more likely to move more than 10%. So that's a whole different kind of risk than you're looking at with Apple or some ETFs or some of the other things there. All right, so Linda had a question about diagonal spreads. This is a trade she was looking at from our diagonal spreads portfolio. And this is directly from the note that we emailed to everybody. Sorry. To open this trade, buy the MU June 18 50 call and sell the MU 226.79 call for debit of 26.60. Okay, so this trade was published on the 3rd of February, and Linda sent this question in earlier this week. So, is it too late to buy in? The answer there is yes. One of the things we say is if you can get the spread at our price, then it's probably not too late to buy in. But from February 3rd to February 16th on a trade that was only supposed to last 3 weeks, yes, that's too late. When we published it, MU was trading about 79. So the 50 call gives you the right to buy Micron at $50. The 79 call potentially creates the obligation to sell Micron at $79. Okay, so above 79, somebody's probably going to want to exercise that call, and they're going to want to buy the stock for 79. So you don't own the stock, but you can buy it for 50 and then turn around and immediately sell it for 79. That is $29. Okay, so you got $29 worth of options, and we bought those options for $26.60. That's how the diagonal spread works. And the way this works is the deep in the money call, the reason you can get $29 for the options for $26.60 is that deep in the money call has a pretty low extrinsic value, and selling that one right at the money, right, 79, has a high extrinsic value. So the stock really doesn't have to do very much, but we still make the full profit. All right, another diagonal spread question. Spread expires on February the 19th. Been trying to close it for 2 days with no luck. Adjusted the price to match the bid ask. Open interest isn't huge, just over 1,000 for each leg. Any suggestions about what to do to close it? So, as I mentioned earlier, open interest is not really a good indicator of liquidity. Open interest is how many people, how many contracts of that are open. It could be one guy opened thousands of contracts and just ain't selling them, right? That doesn't do you any good. Whereas if there's somebody who doesn't have any contracts, who's interested in buying the contract you're trying to get out of, that does you a lot more good. So again, bid-ask spread is way better indicator than open interest. All right, so as we just talked about on the last one, assuming your sold call is in the money, try entering a closing order for the strike width, right? It's not impossible to get more than $29 out of this micron spread that we talked about here, but the options are worth 29 bucks. And I know, right, like we talked last time about GameStops and some things that are just insane, but generally markets are efficient, okay? Trying to sell $29 worth of options for more than $29 is tough. So probably not going to happen. But yeah, depending on moneyness, it should close no problem there. If it's right at the money, it may take a little longer. But if that sold call is in the money by any distance at all, it should close at the strike width. And the other thing to do is, bump the credit down. You can try pennies, drop it in. I don't think I've ever had to drop a diagonal spread where both legs were in the money by more than a nickel to get it filled. That's just kind of how that is. And the other thing is, you could hold it through expiration, assuming you have a broker that doesn't charge exercise and assignment fees, which most of them don't anymore. There's no real difference from doing that than just letting it roll. You may have to actually exercise that 50 or exercise the bought leg or sell it, over the weekend or Monday morning. But yeah, that's the other thing there. And yeah, if you sell at the bid and buy at the ask, you should get filled. Often that price is unattractive, so that's why we always talk about using limit orders and knowing what the options are worth. But yeah, that shouldn't be a problem. All right, please discuss the Tilray Ephira merger. How does Tilray stand to benefit? Jim. All right, so the merger is Ephira shareholders get 0.8, we'll just call it 0.8 shares of Tilray. There are more shares of Ephira than there are of Tilray. So even though Ephira shareholders aren't getting a whole share, they're still going to own most of the company after this merger. Okay, I'm not really an expert on pot stocks, but it seems like these companies have relatively similar businesses. They're both in the sort of production and sales. They grow and sell pot and some pot related products. And so what it looks like to me is the deal is really about scale. And yeah, I think they're probably going to be about the biggest producer, which gives them probably some pricing power. It means that if there's any kind of shortages or anything like that, this combined company is the company you come to. And I would expect to see more mergers as the industry grows. All right, look at Tilray, CGC, ACB to see where we're heading technically. I'm going to look at probably one of these just because of what time it is. And they're pretty well correlated, so there isn't usually a whole lot of difference. I'm going to look at one that's not Tilray, though, just because that merger makes a difference. All right, so, if you look at our scores here, the fundamentals aren't great. The company doesn't make money. That's why that is. Analysts don't love it, so that costs us some points. But technically, it looks okay. And the short-term technical is better than the long-term technical, which tells me that there's been some relative outperformance over the short term, more so than the long term, right? 80 versus 87 isn't a huge difference, but that's what those things mean. And then, yeah, things got a little nuts a week or two ago with the pot stocks, and they pulled back some. But really much beyond that, we're still, well, so CGC is actually not as far away from the prior nuttiness as I might have guessed. I think Tilray, or well, I'm sure Tilray. ACB is the other big one. Yeah, so ACB has done a little bit worse technically, but I think they're probably actually further away from their, yeah, they're really far away from their prior pot stock mania peak. But yeah, I mean, generally it seems like we're sort of moving toward, more likely moving toward legalization than away from it. So that's probably a positive. I think that's probably a bigger deal for these guys than any sort of technical or other thing that's happening there. All right, so if different insiders, for example, in GoDaddy transactions are taking place, different analysts adjusted the price target higher, but the sentiment is bearish. Why are the insiders selling if the target price is being raised, and does it make it a good or bad pick as an investor? Okay, so an important thing to understand about insider transactions is insider selling isn't really the opposite of insider buying. Okay, so people who qualify as insiders receive part of their compensation in shares. Okay, so what insider buying means is I'm willing to take some of the cash that I get paid, or cash that I have lying around, some cash anyway, and convert it into shares of a company. Okay, that's what insider buying means. What selling means is I want to spend some of my pay. Those are two very different things. Okay, so buying is typically seen as a positive, and I tend to think it is a positive. Selling, it's really difficult to tell those motivations, and so it's really hard to take selling as a negative. So our news partner includes some interesting information about these transactions so that I think can be useful. So first of all, this particular sale, this is the most recent one I could find for GoDaddy, was 3,000 shares, and this person still has 60,000. So they're not selling a huge chunk. And then there is some pattern of insider selling. It's 12 people have been selling, well, okay, it's 12 transactions by 4 people selling a total of that many shares. That kind of seems high, but you don't know how many shares those people had. And the other thing is, this level of insider transactions is below that of the peer group. So fewer insiders at GoDaddy are selling than insiders at other similar companies. So I'm not super worried about this. And that also kind of explains why analyst price targets are different, right? Because analysts don't care about insider selling. The insider selling is really hard to tell what that is. And so, yeah, worry about it way less. If it looks high, right? If she cashed out all of her shares, or if the level of insider transactions is higher than that of the peer group, that might be something to take note of, but it's really hard to attribute some sort of bearish thing to selling in the same way that buying is almost universally a bullish sign. Okay, I invested in Riot, a crypto mining company, almost doubled my money. Are these mining companies looking solid for the future? Are there signs of regress? Seems like in the future, but again, seems like a counterfeiting scheme. If I started printing money, I'd be in jail. All right, so what Bitcoin mining does, it does the back office work, essentially. Okay, so Bitcoin mining currently uses roughly the same amount of electricity as the nation of Argentina. So essentially what happens is your computer does a bunch of math, and the system hands out some Bitcoin for every so often. And what that math is keeping track of all the transactions. Okay, so Bitcoin is decentralized and independent of banks, et cetera, et cetera. So the sort of premise of Bitcoin is, what if we didn't have to trust anybody? Okay, I have some Bitcoins, I pay somebody else, and then I pay another person, and then I pay another person, because that's how spending money works. the bank knows, okay, Bobby has $5. He can't give $5 to the same $5 to 3 different people, and the bank will just adjust my balance down. Well, Bitcoin, there are no banks, right? So Bitcoin has this ledger. It's called the blockchain. It says you gave this Bitcoin to this person. You can't give the same Bitcoin to that person. So it solves what we call sort of a trust problem. Okay, you trust the bank to not let me spend more money than I have. Bitcoin does that through this complicated back office process. It uses a ton of electricity and occasionally throws off some extra Bitcoins. So currently there's 18.5 million Bitcoins. The actual Bitcoin system is only set up to allow 21 million. And also the reward for mining is halved every 4 years or so. It was halved last year. It'll be halved again probably about 2024. Okay, so what that means is for mining companies like Riot, the price needs to double every 4 years to make it worthwhile, which from 2016 to 2020, more than doubled, no problem. So the questions I have are, first of all, what happens to a company whose job is Bitcoin mining after we hit 21 million? I don't know. No one really seems to know, because I'm not going to buy a bunch of electricity to do this Bitcoin mining if I'm not getting anything for it. They could adjust the system to make more Bitcoins. One of the things that the Bitcoin people really like about Bitcoin is the number of Bitcoins is capped, so it can't be inflationary. So I don't really know how they're going to solve that problem. But yeah, all these things basically seem like bets on the price of Bitcoin, right? Like if you buy Riot, you're basically betting that Bitcoin will go up. There's another company, MicroStrategy, that started buying a bunch of Bitcoin, and they're selling like $900 in bonds to buy Bitcoins. This is a company that had 400 million in revenue in 2020, and they weren't profitable in 2020. I feel like either one of these are bets on the price of Bitcoin. If you want to bet on the price of Bitcoin, the best way to do that is probably buy Bitcoin, and then you don't get a bunch of other weird problems like what happens to mining after 21 million. So yeah, I guess that's my thing there. And then, yeah, so the interesting thing about printing money is, mining hasn't actually been inflationary, right? The price of Bitcoin in dollars keeps going up. The Bitcoin economy is, if in anything, in severe deflation. Okay, it was 40,000 2 weeks ago. It's 50,000 today. Every day your money is worth more. You never want to spend that money. That's deflation, right? That's bad. Right? If you have an economy where nobody spends money, you don't really have an economy. And then the other thing is there are lots of other coins, right? Dogecoin has been in the news recently. So when you say if I started printing money, I'd be in jail, that's not really true. If you started printing dollars, you absolutely go to jail. You can make as many other things as you want and tell people their money, and that's totally fine. The limiter is how many of those things can you make will people actually take as money? And I don't really know the answer to that. I don't really think anybody does. That's why the whole Bitcoin experiment has kind of worked, is because people are like, well, sure, seems like money to me, and they keep buying it. All right, can I discuss pre-IPOs and SPACs? So an IPO is an acronym that stands for Initial Public Offering. Pre-IPO shares aren't available to the public. I've looked around for this. There's a couple things. I can't figure out exactly what the actual offer is. But yeah, as a regular investor, you cannot buy pre-IPO shares. That's not a thing. Now, if you're an accredited or qualified investor, you can buy pre-IPO shares. You have access to private equity and things like that. And to be an accredited investor, you need to have income of more than $200,000 in the previous 2 years, or net worth of more than $1 million. There are some other ways for regular people to get access to sort of pre-IPO funds. Mutual funds. Fidelity famously was a big Uber investor before that IPO. And so certain Fidelity mutual funds had Uber shares and got to take advantage of the IPO and things like that. But yeah, the initial public offering is the initial, which means first, public offering. That's the first time the public can buy stock. So most of these things that are advertising pre-IPO shares, I couldn't figure out exactly what it is they're trying to sell you, but it is not shares of a company that hasn't IPO'd yet, unless you're in this accredited investor category. All right, and then special purpose acquisition vehicle. So this is the hot new, well, it's not new, it's the hot financial vehicle of the moment. Yeah, so what happens in a SPAC is you have an IPO to raise a pool of money, but you don't have a company, you just have a pool of money. And each person who buys shares in the IPO gets some shares plus warrants to buy more shares at some point in the future. Also, the manager of the SPAC gets some shares, a lot of times without putting any money in. That's how they get paid for, being a great SPAC manager. And then the SPAC goes out and acquires a private company. And before the acquisition, the shareholders in the SPAC have the option to get their money back if they don't like the deal. Okay, so if I invest in a SPAC and you say, all right, we're running the SPAC, we're going to go buy this company. I'm like, I don't think I like that company. I can get my money back. Almost all these things IPO for $10. For whatever reason, I guess it makes it easy and standard. So yeah, if you don't like the company, you can just vote no and get your $10 back. And that's how that works. So the problems with this are there's obviously some dilution from the manager, right? So you paid $10 for a share of the SPAC. Well, the manager got an interest in the SPAC without putting any money in, or he got more shares than were commensurate with his money that he put in any case. So that means you already own less than $10 worth of the company because the company is a bunch of $10s, and now there's other people who own some stake of those $10s. All right, so, and then what happens with these SPACs now is typically there's a merger rumor, or sometimes not even, and they start trading at prices that are different than the IPO price. Well, so if I gave you $10 and said, go buy me $15 worth of lunch, and then also buy something for yourself with that $10, what I'm betting on at that point is your negotiating skills, right? I'm not, that seems crazy to me. And it may work sometimes. Some of the SPACs have worked out, some of them don't. But just the basic math there seems to me like it's putting the SPAC investor kind of on the wrong foot. And then the other problem is, there's just way less disclosure than in the IPO process. You know less about the company that you're buying than you would if you were buying shares in an IPO or after an IPO. And then, I mean, just generally, the performance hasn't been great. DraftKings hasn't done terribly. Virgin Galactic, or whatever that space company is, hasn't done terribly. But yeah, the number of SPACs that are absolute home runs is a lot less than the number of SPACs where it's like, that was kind of a dud. So yeah, there's that. All right, so it is already after 5. I'm going to scan through here real quick and see if there's any questions I feel like I have to get to. And then, there might be some other things that I will follow up with people after the fact. All right, so we got one question about shorts, and this has been around a lot lately. So many stocks I'm profiling show that they're 80 to 90% owned by institutions. Also report millions of shares are shorts. When does the percent short become a danger to avoid a position in the stock? And can the 20% available to the retailer make a difference to that trend? All right, so a couple of things here. First of all, there was a lot in the news about GameStop having a short float of more than 100%. And they were like, oh, well, how can you have more shares short than exist? Well, the reason you can have more shares short than exist is if I buy the stock, I can loan it somebody to short, okay? And they'll pay me interest because it's a loan, okay? So all those institutions, one of the ways they make money is loaning out shares to short. They don't care, they're long. The short blows up, big deal. They get their shares back, they get some interest along the way, not their problem. Okay, so, but the short seller takes my share that I loaned him and sells it. So now there's 2 people who are long the stock, me and the guy the short seller sold it to, and 1 person who's short. Okay, so yes, the float is the total number of shares, but a share can be, every short creates a new long, essentially. Okay, so that 120% of the float is kind of interesting, but the idea that 100 is a hard cap is nonsense. Okay, anybody who's telling you that doesn't really understand how short selling works. All All right, and yeah, I mean, high short interest can be a danger sign. It's certainly worth looking at. Typically, what it means is the company is overvalued, right? If you look at the high short interest list and look at the high PE list, most of the time it's the same list. So yeah, I mean, it's certainly a thing to consider. If you're a value investor, there's probably 17 things that mean a stock with high short interest don't make the cut before you get to looking at the short interest. And the other thing I'll say about GameStop and stocks with high institutional ownership is the Wall Street Journal had a story last week that Fidelity, a big institution that was long, they basically cut their entire GameStop position when it went nuts. Because yeah, like if you're running a mutual fund and a stock goes up by a couple thousand%, you sell the stock every time. So yeah, it's not necessarily the shorts that are your enemy if you get involved in something like that. It's also the big longs who are sitting on a massive gain. All right, we'll do a speed round here. Trading ETF options have an advantage over stock options in predictability and safety. In the sense that ETFs tend to be less volatile than individual stocks, yes, there is some advantage. However, the thing about options is the option prices are a function of volatility. So if you're selling options, in any case, you tend to get less for selling that option on a lower volatility instrument. All right, I don't see a ton of questions here that I necessarily need to answer right now. I'm sorry I didn't get to everybody, but we're like 10 minutes over time. I'll follow up with people by email tomorrow if I feel like this needs to be, if it needs to be followed up on. We'll post a recording of this tomorrow and send everybody an email when it's up. Thank you for coming. Thank you for subscribing to Investors Observer. You don't have to wait for these. You can hit that help button in the bottom corner of the screen right here and send us an email at any time. We get back to them pretty quickly. Yeah, thank you all for coming, and I will talk to you again in 3 weeks.